In this presentation, we will discuss how to organize and implement a capitalization policy to best benefit your small business. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information are not intended to create, and receipt does not constitute, an attorney-client, or any other advisory relationship. Reproduction of this information is expressly prohibited. Only non-commercial uses of this work are permitted. Though creating and employing a capitalization policy for your childcare business may seem complicated, there are many worthwhile benefits to doing so, not the least of which is complying with U.S. Internal Revenue Service requirements. A good capitalization policy can help your business approach large expenditures with consistency and allows you to categorize many purchases as expenses, and which would therefore be deductible in 1 year. In today's conversation, we will explain what a capitalization policy is, why you need one, and what to include in your policy. In accounting, you typically treat any large purchases or those items with a life of more than 1 year, like a dishwasher or furniture, as a capital expense. This means that even though you paid for it this year, you will need to deduct the cost over many years. This is called depreciation. For example, let's say you purchased a couch used exclusively for your childcare business for $700. Even though you paid for it this year, you would only be able to deduct $100 a year over 7 years. That means that even though you spent the money this year, you'll pay extra taxes on it. This would be a challenge for small businesses, so the IRS created a safe harbor that provides an exception if you have a capitalization policy in place. With a capitalization policy, you can say that any item you buy which is less than $2,500 can be treated as a current year expense, even if it has a life of more than 1 year. In other words, the policy allows you to skip depreciation for items less than $2,500 and deduct them this year, keeping your taxes lower. Typically, most small businesses opt to create a capitalization policy at the highest limit, which is $2,500. You can set it lower, but this level allows you the greatest advantage on your taxes and in your bookkeeping. Creating a policy is very simple and takes only 3 steps. First, create it. Then sign it. And finally, file it. When creating your capitalization policy, you should include the following items. First is purpose. Clearly state the purpose of the capitalization policy, which in this case is to establish the minimum cost or capitalization amount for recording capital assets in the company's annual financial statements. Next is a capital asset definition. Provide a clear definition of what constitutes a capital asset. Typically, you will want to include items with a useful life of more than 1 year and a cost of $2,500 or more. Third is capitalization thresholds. Set the threshold amount for minimum capitalization. Then capitalization method and procedure. Outline the method and procedure for capitalizing assets. And finally, record keeping. Be sure to specify the record keeping requirements. Here is an example of how to use these 5 categories to develop your own policy. The purpose of this capitalization policy is to establish guidelines for the recognition and recording of capital assets in the company's financial statements, ensuring consistent and appropriate treatment of these assets. A capital asset is defined as a tangible or intangible asset that meets the following criteria. A. It has a useful life that extends beyond 12 months, and B. It was acquired or produced for a cost exceeding $2,500. The threshold for capitalization shall be set at $2,500. All assets meeting or exceeding this cost shall be capitalized, while assets below this threshold shall be expensed in the period of acquisition. Capital assets shall be recorded at their historical cost, including all costs directly attributable to bringing the asset to its intended use. Tangible assets falling below the capitalization threshold shall be recorded as expenses in the financial statements of the period in which they are acquired. capital assets with finite useful lives shall be depreciated or amortized using appropriate methods over their estimated useful lives. The depreciation or amortization expense shall be recognized in the financial statements on a systematic basis. All supporting documentation, including invoices, contracts, and relevant financial records, substantiating the acquisition cost of capital assets, shall be retained for a minimum of 4 years from the date of disposal or retirement. This capitalization policy shall be periodically reviewed to ensure its relevance and effectiveness. Once you have developed your policy, be sure to sign it. It is important to have a signed copy on record in case of IRS audit. Even if you are a sole proprietor and you are the only employee, you should still sign it. Once you have created and signed the policy, the final step is to file it. Keep both a paper and an electronic copy of the policy, just in case you need it in an audit. This can be as simple as keeping a paper copy in your files and taking a photo of it for a digital version. Even though it may seem like some extra steps, creating a capitalization policy will allow you to legally expense many more items and have a clear reason for doing so if you are ever audited by the IRS. Thank you for joining me for this discussion today. If you are interested in other helpful resources, information, and guides, visit childcare.texas.gov to find these on various topics in both English and Spanish. There you can also sign up and register for free one-on-one business coaching.